Hi, I'm John Darer, and today we're talking settlement. The topic of the day is non-qualified structured settlements. What is a non-qualified structured settlement? A non-qualified structured settlement is a form of settlement using customized periodic payments to receive taxable damages in a tax-efficient way. All or just a portion of the settlement can be structured in a taxable damages case, as well as the taxable portion of a personal injury settlement. ForStructures.com has a variety of fixed and market-based non-qualified structured settlement solutions by way of domestic and non-qualified assignments, funding agreements, periodic payment assumption reinsurance, and domestic periodic payment agreements. What is a non-qualified assignment? A non-qualified assignment is an important settlement planning tool to help plaintiffs keep more of their taxable damage settlements while defendants get a complete release. A non-qualified assignment is a form of settlement used to resolve legal disputes or claims for taxable damages that do not fall within the traditional realm of physical injury, physical sickness, wrongful death, or workers' compensation. There are many different ways to use non-qualified assignments, and the tax benefits vary with the type of transaction. When a plaintiff spreads out the plaintiffs from a settlement, they can avoid the heavy taxation that accompanies a lump sum payment. One can also avoid losing various government benefits due to a sudden increase in income, and non-qualified assignments are one path to provide more flexibility for investing settlement monies with tax efficiency. What are the tax benefits of a non-qualified structured settlement? Well, tax deferral is really the primary benefit of a non-qualified structured settlement. Non-qualified structured settlements are useful to avoid heavy taxation in the year of settlement and to kick the taxes down the road. The tax benefits vary by the type of transactions, but generally, one can earn interest on the tax deferred. You can earn interest on the deferred taxes tax deferred, and you can earn interest on the interest tax deferred. In addition to the tax benefit, a non-qualified structured settlement allows the plaintiff to avail themselves of popular benefits associated with normal structured settlements, such as stable income for a fixed period of transition, or if desired, for a lifetime. For each type of application, there is a different nuance in the procedure, and we can help the parties achieve their objectives. How does a non-qualified assignment work? Well, generally it works just like this. The parties come to an agreement. They then execute a settlement agreement and release, or a sales agreement in the case of structured installment sales, that includes periodic payments as part of the consideration. There are fixed annuity, US Treasury funded agreements using a non-qualified assignment, indexed, reinsurance, and market-based funding options for non-qualified assignments. With an annuity-funded non-qualified assignment, or one funded with a funding agreement, the payments are fixed and determinable as to the amount and payment dates. With a non-qualified assignment using a market-based option, the periodic payments are set as to payment date, but the payment amounts are based on a fixed and determinable or objective formula. The non-qualified assignment company accepts the funds, which purchases the funding instrument, along with the obligation to make periodic payments to the plaintiff or a payee. The assignment in a non-qualified assignment is a general assignment which is unrelated to qualified assignments under Section 130 of the Internal Revenue Code. Payments are generally fully taxable to the payee in the tax year that each payment is received. The type of tax will depend on the type of transaction. Damages in wrongful conviction or wrongful imprisonment cases, which are excluded under Internal Revenue Code Section 139F, can be paid using a structured settlement, but must be established using a non-qualified assignment because Section 130 only covers assignment of damages under two sections of the Internal Revenue Code, not including Section 139F. The required documentation will actually vary by the type of transaction, and we can go over that with you if you like. Domestic and non-domestic non-qualified assignment options foster settlements in many types of claims and lawsuits. Non-qualified assignment solutions are available through our relationships with domestic assignment companies such as MetLife Assignment Company, Inc., and AGL Assignment Company, LLC. The AGL solution offers both immediate and deferred payment streams, the latter using a funding agreement. Offshore options include structured assignments, SCC, Havlet assignments, Kenmare assignments, and a few others. For those comfortable with it, a non-domestic assignment company opens up the possibility of a deferred payment mechanism with a structured settlement annuity issued by a Texas-based life insurer, or a private placement annuity, or customized managed portfolio that could include different asset classes as well as fixed income from structured settlement payment rights purchased in the structured settlement secondary or tertiary market, or a Vanguard fund. For the most conservative, another non-annuity alternative is a non-qualified assignment using Treasury-funded structured settlements. United States Treasury obligations are purchased by a trust administered by a domestic trust company to back up the assigned periodic payment obligation. At the very least, all of these options offer an opportunity to diversify risk. Where can non-qualified structured settlements be used? Examples of cases involving taxable damages or payouts where settling parties to a lawsuit, claim, or dispute or contract may benefit from a non-qualified structured settlement include the following. First of all, the category of employment lawsuits: age, gender, race, or religious types of discrimination settlements, disability buyout settlements, failure to promote, sexual harassment, sexual assault settlements such as those arising out of actors in Hollywood, television, music industry, universities, religious institutions, sexual harassment, employment, things that you read in the newspapers. Wrongful termination settlements, wrongful dismissal. Different types of corporate and professional settlements such as company-paid LTD settlements, construction defect settlements, products liability where there's taxable damages, directors and officers and related claim settlements, errors and omissions claim settlements, creating an ongoing funding source for cleanup and long-term monitoring of cleanup sites that are a subject of environmental claims, funding of lotteries and contest winnings, intellectual property claims of inventors and copyright and trademark holders, lease buyouts for cash basis taxpayers. There are other solutions for accrual basis taxpayers. Pre-August 5th, 1997 workers' compensation claims, punitive damages awards. For personal type of claims involving individuals, there are divorce settlements where you can secure periodic payments of divorce alimony, spousal support, and equity distribution. Emotional distress and psychological claims if not derived from physical injury. Structured installment sales for people looking to exit businesses or real estate properties or oil and lease gas bonuses. In the miscellaneous categories, we got breach of contract claims, wrongful imprisonment, false arrest. And again, note that Section 139F damages are tax exempt, but it's not part of Section 130, so a qualified assignment cannot be used. And then finally, fraud claims. So let's talk about the benefits to the parties. First of all, the benefits to the plaintiff. The decision to accept the distribution by the way of a non-qualified structured settlement is based upon which form of distribution puts the largest amount of net settlement proceeds in his or her pocket. In a non-qualified tort settlement, the net settlement proceeds represent the settlement less attorney fees, liens, and taxes. With a lump sum settlement, the plaintiff may end up being taxed at the highest rates or may even be subject to the alternative minimum tax. So with a non-qualified structured settlement, the plaintiff may be taxed at a lower rate that is applied to comparatively smaller periodic payments, thus producing a smaller tax burden that would be created by a lump sum settlement. When used as part of the resolution of a divorce case to fund alimony or spousal support or child support, a non-qualified structured settlement provides vital payment assurance to the recipient spouse. But could you do better on your investments than a non-qualified structured settlement? If you think you can do better on investments, remember that first you have to earn enough just to catch up to the amount you would have started with had you structured. Moreover, there is a have your cake and eat it option too, with market-based non-qualified structured settlements. So let's talk about how the defendant benefits. Unlike with a qualified assignment, the tax deduction here may be taken over time in certain types of cases because that's when the payments are made to the plaintiff. This may be offset by the following advantages. Tax savings accruing to the plaintiff may be so great that the defendant or payor gains leverage to negotiate a potentially lower settlement cost, enabling the parties to bridge the gap in negotiations. Facilitating settlement thereby avoids additional trial costs, avoids risk of punitive damages, avoids exposure to runaway jury verdicts, avoids adverse jury findings that could lead to appeal and post-appeal expense. We have customized solutions to solve problems and to accommodate specific cash flow needs and preferences of our clients. For more information, please contact me at the number below. Thank you for watching. I'm John Dare, and have a great day.